Welcome to the Deep Dive, where we unpack the stories that matter, cutting through the noise to get straight to the insights. Today, we're diving into a really fascinating development that just emerged from the highest echelons of U.S. policy. It's one that could profoundly reshape how you think about and maybe even invest your retirement savings in this rapidly evolving world of digital assets. Our mission on this deep dive is to truly understand a pivotal executive order signed by President Donald Trump on August 7, 2025. This isn't just about headline-grabbing news, it's about a concrete directive, one that aims to open the door for digital assets to be included in your 401k. We'll explore the precise language, the strategic motivations behind it, and the immediate, pretty powerful ripple effects it sent through global markets. You should walk away with a clear picture of what this means for your financial future and really the broader digital economy.
Yeah, and what's truly compelling here is just the sheer magnitude of this potential shift. We're not just talking about, small incremental changes for individual investors. This feels like a clear declaration of intent by the U.S. to really cement its position in the global digital asset space. It could fundamentally alter the trajectory of financial infrastructure, innovation. I mean, this executive order isn't just politics, it's a strategic economic maneuver.
Okay, let's unpack this with the precision it really deserves. We're talking about an executive order signed by President Donald Trump, August 7, 2025. Now, for anyone who follows policy, executive orders are powerful tools, aren't they?
Definitely.
They bypass the typical legislative process, allowing the president to issue direct commands to federal agencies. So this isn't merely a suggestion or some long-term aspiration. It's a direct command with very real, tangible financial implications, potentially affecting millions of Americans and, well, billions in assets.
Exactly. And this particular order zeroes in on retirement accounts, specifically directing agencies to open up access for 401k investors to what are broadly termed alternative assets. And critically, digital assets are explicitly called out within that category. That's key. This looks like a very deliberate move, clearly designed to fulfill some campaign promises about fostering a, let's say, more favorable regulatory environment for the digital asset sector. It's the government actively trying to streamline pathways for a new asset class into those traditional financial vehicles.
Right. To get into the weeds just a bit, the official announcement states it directs the Secretary of Labor to re-examine the Department of Labor's guidance on a fiduciary's duties regarding alternative asset investments in ERISA-governed 401k and other defined contribution plans. Now, that's a mouthful, but for our listeners familiar with 401ks, ERISA is the bedrock, right? The Employee Retirement Income Security Act. It sets incredibly stringent rules around how fiduciaries, the people managing your retirement funds, must act, emphasizing prudence, loyalty. So for fiduciaries who historically been quite cautious, naturally because of ERISA's strict rules, what specific regulatory hurdle is this re-examination aiming to remove, and what does that signal about maybe the Dole's prior stance?
Well, that's really the crux of it. Historically, the Department of Labor, the Dole, has been very wary of digital assets in 401ks. They even issued cautionary guidance a while back. They raised concerns about volatility, valuation challenges, the potential for fraud, essentially putting a chill on fiduciaries even thinking about these assets. So this executive order, by directing a re-examination, is signaling a potential reversal, or at least a significant softening of that stance. It's aiming to provide a clearer, maybe safer path for fiduciaries to evaluate and potentially include digital assets without fear of immediate regulatory backlash or, legal repercussions. It essentially gives them the regulatory cover they've perhaps been waiting for. It's a move from a position of caution to one that actively explores opportunity, but still within that existing framework of fiduciary duty.
Okay, so that brings us to the crucial why. Why this push for digital assets now, and why from the president's desk directly? The source material frames this explicitly as a significant part of Trump's broader plan to establish the United States as the leading player in the cryptocurrency industry. This isn't just about individual investors getting more choices then. It sounds fundamentally like national economic strategy.
Indeed. And that raises an important question. What's the underlying belief system, or maybe economic philosophy, driving this specific directive? The order itself isn't shy about stating its reasoning. It stipulates that alternative assets, such as private equity, real estate, and digital assets, offer competitive returns and diversification benefits.
Right. Diversification being the key word there.
Exactly. And this isn't just a generic statement. It signals a fundamental belief within this administration that digital assets, maybe unlike traditional equities, could offer unique benefits. For instance, some proponents argue that assets like Bitcoin could offer a hedge against inflation, or maybe even provide uncorrelated returns during certain market cycles, kind of acting as a true diversifier when traditional markets are in turmoil. This view, while definitely debated, has been gaining significant traction among some institutional investors looking for new avenues for portfolio resilience. It's a shift from a purely cautionary stance to one that actively identifies and seeks to leverage the potential strategic advantages these assets could bring to a diversified portfolio, especially for long-term savings.
But hang on. For an audience like ours, which is deeply engaged in financial planning, the idea of introducing what can be highly volatile assets, like Bitcoin, into retirement accounts, especially as someone gets closer to retirement, wouldn't that raise concerns about undue risk?
Oh, absolutely.
Does this order, or the philosophy behind it, address those valid concerns about investor protection, the potential for significant drawdowns? Because diversification often comes with that big caveat of understanding risks.
It's a critical point, and it's one that the re-examination of guidance will undoubtedly have to grapple with. While the order itself emphasizes potential benefits, the very nature of ERISA means any new guidance from the DOL would still need to uphold those fiduciary standards of prudence. So this likely implies that while the door might open, it probably won't be a free-for-all. Fiduciaries would still be expected to conduct thorough due diligence, perhaps only offering access to a limited selection of more established digital assets, or maybe requiring robust risk disclosures, something along those lines. It's about balancing opportunity with protection, right? And the success will really hinge on how comprehensively the new guidance navigates that tension. The goal seems to be to allow the option, but not to mandate or carelessly encourage it without proper safeguards in place.
So it's about making the U.S. a leader, providing diversification, but with an underlying assumption that the implementation will still need to adhere to prudent financial management.
That seems to be the idea.
And it really is about more than just giving individuals more investment choices. It's about leveraging this emerging asset class as a tool for national economic strategy, positioning the U.S. at the absolute forefront of this rapidly evolving financial frontier. It's a statement about where the country sees its future economic strength lying, aiming to attract innovation, talent, and capital in the digital space.
Precisely. It's a declaration of intent to lead, rather than simply regulate from a distance or reactively. By creating, or attempting to create, a clearer regulatory environment, the U.S. aims to become a more attractive jurisdiction for digital asset companies, for developers, for investors. This could profoundly influence global innovation and capital flows in the digital asset space, potentially drawing businesses and investment away from regions with, let's say, less regulatory clarity or more restrictive stances. It's an embrace of a technological and financial shift that the administration seems to believe is inevitable, and they want the U.S. to be at the helm.
Okay, here's where it gets really interesting for everyone watching the markets. They're always hypersensitive to regulatory news from major economies, aren't they?
Always.
How did the digital asset market react to this immediate news of the executive order?
The reaction was almost instantaneous and quite dramatic, really, which is somewhat expected for such a significant policy signal. The entire digital asset market soared on the news. Bitcoin's price, for instance, immediately surged, trading above an impressive $117,000, charging a 2% intraday increase right after the announcement. This movement is a clear demonstration of just how sensitive the market is to these regulatory signals, especially from a major economy like the U.S. It immediately signals greater legitimacy, potential for wider adoption by institutional capital, reduced regulatory uncertainty, all catalysts for price appreciation in this space.
And it wasn't just the dominant player, Bitcoin, right?
Not at all.
Ethereum, which gets a lot of discussion for its smart contract capabilities and its role in decentralized finance, also saw significant gains.
Yeah, it jumped by 5% almost immediately. The ripple effect was broad, leading the total market capitalization for digital assets to reach a staggering $3.93 trillion.
3.3 trillion.
Yep. And Bitcoin's dominance started looking to reclaim that significant 60% mark again.
So this wasn't just a blip or a transient spike. It was a market-wide embrace of what's perceived as a massive step towards mainstream adoption. Can you elaborate just a bit on why Bitcoin's dominance reclaiming that 60% mark is particularly noteworthy, beyond just its own price increase?
That's a great observation. Bitcoin's dominance, basically its market cap as a percentage of the total digital asset market, often indicates overall market health and, importantly, risk appetite. When Bitcoin's dominance rises during a broad market surge like this, it suggests that institutional and larger-scale capital is flowing into the most established, most liquid, and arguably safest digital asset.
The gateway.
Kind of. It implies that this regulatory clarity isn't just fueling, say, speculative retail trading, but is seen as a signal for more conservative long-term institutional capital to enter the space. And they often start with Bitcoin as a gateway asset. So this rapid and widespread surge underscores the immense significance of both institutional adoption and regulatory clarity for this asset class. When a major economy like the U.S. signals a more welcoming and clear stance, capital often follows, and it does so very quickly, impacting valuations right across the board.
So, okay, let's bring it back. What does this all mean for you, the individual investor, or someone simply planning for their future retirement? If this guidance reexamination leads to concrete changes, and it seems like it might, it could fundamentally alter the investment landscape within your 401k. We're talking about entirely new avenues for diversification and potentially different return profiles within your retirement savings portfolio. Imagine having a broader, more modern toolkit for your financial future.
Exactly. And this development raises a really important question for individuals to carefully consider. How do these new opportunities align with your personal long-term financial goals? And crucially, your individual risk tolerance. It's not about rushing in or blindly allocating funds. It's about understanding this evolving landscape and making truly informed decisions about your financial future. For someone already well diversified across traditional assets, this could offer a way to gain exposure to a new growth sector. For others, it might mean very careful consideration of how much, if any, to allocate, given the inherent volatility we talked about. It offers choice, definitely, but choice always comes with the need for education and careful consideration of one's own financial circumstances and goals.
So we could potentially see 401k menus expand beyond just the typical mutual funds and target date funds to maybe include some digital asset options. How might a sophisticated investor, someone already well-versed in rebalancing strategies and risk management, approach this new opportunity within their long-term retirement planning?
Yeah, for a sophisticated investor, this order could actually be a bit of a game changer for portfolio optimization. They might look at digital assets not as a primary holding, obviously, but maybe as a small strategic allocation, perhaps, say 1 to 5% of their total portfolio, aimed at enhancing long-term growth or maybe providing that hedge against certain macroeconomic factors like inflation, which we touched on earlier.
Strategic, not speculative.
Precisely. The key here would be disciplined rebalancing, treating digital assets like any other asset class that can become over or underweight in the portfolio. They'd also likely favor the well-established, highly liquid digital assets over smaller, more speculative ones, especially within a retirement context. And they'd scrutinize the specific investment vehicles offered within their 401k very carefully to ensure they're legitimate and, importantly, cost-effective. It's really about using the option of digital assets to potentially enhance a well-structured, diversified portfolio, not about gambling with retirement savings.
This deep dive into President Donald Trump's executive order reveals, I think, a truly significant step towards integrating digital assets into mainstream financial planning, and specifically into retirement savings. It's a very clear signal about the future direction of both U.S. policy and the evolving nature of retirement investments for everyone.
Absolutely. The implications are vast. It hints at a future where digital assets are no longer just a niche, speculative investment class, but perhaps a recognized, maybe even recommended component of a diversified financial portfolio, which really begs the question, doesn't it? What will this mean for the next generation of investors who grow up with this reality, where digital assets might be as common in a 401k as a stock mutual fund currently is? And how might it fundamentally reshape traditional financial advice and planning as we know it? Will digital asset advisor become a common specialization? It really makes you wonder.
Food for thought indeed. We hope this deep dive gave you a clear and concise understanding of this major development and its profound potential impact on your financial future. If you found this discussion insightful, be sure to subscribe, like this deep dive, and definitely hit that notification bell so you don't miss our future explorations into the topics that matter most to your world.